After 4 decades in finance and navigating multiple geopolitical crises, I've learned that war fundamentally changes the investment landscape in ways most investors completely underestimate. Right now, we're living through what I consider the most dangerous geopolitical environment since the Cuban Missile Crisis. We have an active war in Ukraine, escalating China-Taiwan tensions, Middle East instability, and the real possibility of broader conflicts that could reshape global markets overnight. At JP Morgan Chase, managing over $3.7 trillion in assets, we've developed systematic approaches to navigating wartime markets through the Gulf War, 9/11, Iraq War, Afghanistan, and now Ukraine. Each conflict teaches us valuable lessons about which investments become toxic during wartime. Today, I want to share the specific stocks and sectors that become extremely vulnerable during wartime periods. These are the actual positions we're advising our largest institutional clients to reduce or eliminate entirely. If you own these investments and conflicts escalate, you could face devastating losses that take years to recover. The damage happens fast. When Russia invaded Ukraine, certain sectors lost 20–40% of their value within days. You don't have time to react once shooting starts. You have to position defensively beforehand. Airlines and travel-related stocks. The first category to avoid during wartime is airlines and travel-related companies. This sector gets demolished during conflicts, and recovery can take years. I lived through this after 9/11 when airline stocks lost 50–80% of their value, and many companies never fully recovered. During wartime, air travel becomes restricted, dangerous, and expensive. Insurance costs skyrocket, fuel prices surge due to supply disruptions, international routes get canceled, and business travel evaporates. The combination of higher costs and lower demand is fatal for airline profitability. When Russia invaded Ukraine, European airlines with Russian airspace exposure saw routes disrupted, fuel costs spike, and Eastern Europe travel demand collapse. Companies like Lufthansa, Air France-KLM, and British Airways faced massive operational challenges and stock declines. At JP Morgan, we specifically warned clients about airlines with high international exposure, weak balance sheets, and aircraft leasing companies with exposure to unstable regions. The travel and hospitality sector faces similar challenges. Hotel chains with international properties, cruise lines, travel booking companies, and tourism businesses all become extremely vulnerable. Marriott, Hilton, Royal Caribbean, Expedia, and Booking Holdings could face significant challenges if conflicts escalate. What makes this particularly dangerous is that travel stocks often look cheap during early geopolitical tensions. But wartime travel disruptions can last for years. The Gulf War recovery took 2 years, post 9/11 took 3 years, and Ukraine is still impacting European travel over 2 years later. Consumer discretionary and luxury goods. The second major category to avoid is consumer discretionary and luxury goods. When countries are at war, consumer behavior changes dramatically. People become more conservative with spending. Governments redirect resources toward defense, and economic uncertainty makes consumers delay major purchases. During wartime, consumers cut spending on non-essentials first. New cars, luxury clothing, expensive electronics, high-end consumer goods. They defer home renovations, cancel expensive vacations, and reduce restaurant spending. Luxury goods companies are particularly vulnerable because their wealthy customer base often has significant stock market exposure. When markets decline due to war fears, wealthy individuals feel poorer and reduce luxury spending. Companies like LVMH, Hermes, Burberry, and Tiffany face multiple challenges: disrupted supply chains, conservative customer spending, currency fluctuations, and security concerns. The automotive sector faces particular challenges. Car purchases are easily deferred during uncertainty. Auto manufacturers have complex international supply chains vulnerable to conflicts. Raw materials like steel and aluminum can face shortages and price spikes. Luxury car manufacturers like BMW and Mercedes-Benz typically see significant declines during conflicts. High-end retailers also become extremely vulnerable. Department stores like Nordstrom, luxury jewelry retailers, and expensive consumer electronics companies all face declining demand as consumers prioritize essential spending over luxury purchases. Technology companies with significant China exposure. Given current U.S.-China tensions and potential Taiwan conflict, technology companies with significant China exposure represent some of the most dangerous investments today. The technology sector has become deeply integrated with Chinese manufacturing, supply chains, and markets. creating enormous vulnerabilities if conflicts escalate. At JP Morgan, we've identified several high-risk categories: companies manufacturing in China, those relying on Chinese suppliers for critical components, companies with significant Chinese revenue exposure, and those involved in sensitive technologies facing potential sanctions. Apple represents the most obvious example. Approximately 95% of Apple products are manufactured in China through partners like Foxconn. China represents 20% of Apple's revenue. A conflict would disrupt both manufacturing capabilities and significant revenue base. While Apple is diversifying to India, this transition takes years. Semiconductor companies face acute China risks. Qualcomm, Broadcom, and AMD generate 50-70% of revenues from China and Chinese companies. NVIDIA, despite restrictions, still has significant Chinese demand exposure. If conflicts escalate, these companies face not only lost sales, but potential intellectual property theft. Electric vehicle companies with China exposure also represent significant risks. Tesla manufactures in Shanghai and generates substantial Chinese revenue. Chinese EV companies like NIO, Li Auto, and Xpeng, listed on U.S. exchanges, could face delisting risks. Traditional automakers with Chinese operations like GM and Ford could face operational disruptions. Semiconductor equipment companies face vulnerabilities because they provide machinery for Chinese manufacturers. Applied Materials, Lam Research, and KLA could face immediate export restrictions and revenue losses if conflicts escalate. Heavily leveraged companies and import-dependent businesses. During wartime periods, heavily leveraged companies become extremely dangerous investments regardless of sector. War creates economic uncertainty, supply chain disruptions, and often rising interest rates as governments finance military spending. Companies with high debt levels face multiple pressures that can quickly lead to financial distress. When conflicts begin, credit markets tighten as lenders become risk-averse. Companies needing to refinance debt during wartime often face higher rates, stricter terms, or complete inability to access capital markets. This creates liquidity crises even for companies with strong underlying businesses. At JP Morgan, we analyze debt-to-equity ratios, interest coverage ratios, and cash flow stability. REITs with high leverage are particularly vulnerable, as many carry debt levels of 6 to 8 times annual cash flows. Retail companies with significant debt loads face particular challenges as consumer spending declines while interest costs rise. Energy companies, despite potentially benefiting from higher commodity prices, can still face severe challenges if they carry too much debt. Companies depending heavily on imports or complex global supply chains represent another dangerous category. Modern supply chains are fragile, and conflicts can disrupt shipping routes, close borders, and create material shortages overnight. During wartime, shipping costs can increase dramatically as insurance rates spike and available routes become limited. Container shipping rates increased 300-500% during the Ukraine conflict as vessels avoided routes and fuel costs surged. Retailers that source internationally face particular vulnerabilities. Fashion retailers face acute supply chain risks because their models depend on quick seasonal merchandise turnaround. Electronics retailers and manufacturers face challenges because supply chains often depend on components from multiple countries. Food companies with international supply chains also become vulnerable during conflicts. Emerging market investments become extremely dangerous during major power conflicts because these markets experience massive capital flight as investors seek safety in developed markets. During wartime, emerging market currencies often collapse, stock markets decline dramatically, and economic growth slows significantly. When major conflicts begin, international investors pull money out of emerging markets and move it to safe havens like U.S. Treasury bonds and developed market stocks. This creates cascading effects where emerging market currencies weaken, making debt service more expensive, leading to further economic stress and additional capital outflows. During the current geopolitical environment, certain emerging markets face particular risks. Countries with close ties to Russia or China could face secondary sanctions if conflicts escalate. Countries with high debt levels or current account deficits could face currency crises if investors flee to safety. Countries with significant commodity dependencies could face economic volatility as prices fluctuate due to supply disruptions. At JP Morgan, we warn clients about emerging market investments that could face severe challenges during wartime, including not only direct investments, but multinational companies with significant emerging market exposure. Companies with substantial operations in potentially unstable emerging markets face asset seizure risks, operational restrictions, currency conversion problems, and employee evacuation costs, energy-intensive industries, and vulnerable financial services. While energy producers often benefit from higher prices during conflicts, energy-intensive industries that consume large amounts of oil, natural gas, or electricity can face devastating cost increases. These companies face a double squeeze, higher input costs combined with reduced ability to pass those costs through during uncertain periods. Chemical companies using natural gas and oil as raw materials, steel and aluminum producers requiring enormous electricity, and manufacturing companies with energy-intensive processes all become vulnerable during energy price spikes. The shipping and transportation sector faces particular challenges because fuel represents a significant percentage of operating costs. Data centers and technology infrastructure companies also face energy cost challenges as large data centers consume enormous amounts of electricity. Agricultural companies that depend on fuel for farming equipment and transportation can also face cost pressures during energy price spikes. Financial services companies with significant international exposure face multiple wartime risks that many investors don't appreciate. Banks with international lending exposure face credit risk if conflicts disrupt borrowers' ability to repay loans. European banks with Russian exposure face significant losses when sanctions made loan repayment difficult. Insurance companies face particular challenges because conflicts can trigger various types of coverage, creating large claims. Investment management companies with international operations can face operational disruptions and asset value declines. Credit card companies and payment processors with international operations can face transaction volume declines and increased fraud during wartime periods. Implementation strategy and portfolio protection. Now that I've outlined the major categories of investments to avoid during wartime, let me explain how we're implementing this defensive strategy at JP Morgan and how individual investors should think about protecting their portfolios. The key insight is that you need to reduce these exposures before conflicts escalate, not after. Once shooting starts, it's usually too late to exit positions at reasonable prices. The time to reduce airline stocks was before 9/11, not after. The time to reduce Russia-exposed investments was before the Ukraine invasion, not after. At JP Morgan, we use a systematic approach to stress testing portfolios for various wartime scenarios. We model how different conflicts might affect global trade, energy prices, currency markets, and specific sectors. We analyze three primary scenarios: regional conflicts that disrupt specific trade routes, major power confrontations that affect global markets, and extended conflicts that create lasting economic disruption. For each scenario, we identify positions that could face severe losses and recommend position reductions or hedging strategies. Our institutional clients typically reduce vulnerable positions by 30-50% when we identify elevated geopolitical risks rather than eliminating exposure entirely. For individual investors, this means taking a careful look at your portfolio and identifying investments that fall into the vulnerable categories I've discussed. Start by calculating your total exposure to each vulnerable sector. If airlines, travel, luxury goods, China-exposed technology, heavily leveraged companies, import-dependent businesses, emerging markets, energy-intensive industries, and international financial services represent more than 30% of your portfolio, you should consider reducing these allocations. Consider implementing a barbell strategy where you maintain some exposure to potentially vulnerable sectors for upside potential during peaceful periods, but balance this with significant allocations to defensive investments that perform well during wartime. These defensive investments include U.S. Treasury bonds, particularly shorter duration securities that provide stability and liquidity. Gold has historically performed well during wartime, though it can be volatile in the short term. Defense contractors often benefit from increased military spending during conflicts. Energy producers typically benefit from higher commodity prices during supply disruptions, making them good defensive holdings. Companies with domestic-focused operations and strong balance sheets tend to outperform during wartime because they are less exposed to international disruptions and better able to weather economic uncertainty. Diversification becomes even more critical during wartime periods because correlations between different asset classes tend to increase during crises. International diversification, which normally provides protection, can become less effective when conflicts affect multiple regions simultaneously. This is why maintaining some allocation to truly defensive assets becomes so important. Most importantly, maintain adequate cash reserves and avoid excessive leverage in your overall portfolio. During wartime periods, opportunities often arise to purchase high-quality companies at discounted prices, but only if you have the financial flexibility to act when others are forced to sell. We typically recommend maintaining 10-15% of your portfolio in cash or cash equivalents during elevated geopolitical risk periods. Consider using stop-loss orders or other risk management tools for your most vulnerable positions. If you own stocks in the categories I've discussed, consider setting stop-loss orders at 15-20% below current prices. This won't protect you from gap-down openings after major geopolitical events, but it can help limit losses during gradual deteriorations in geopolitical situations. Review your international exposure carefully. While international diversification is normally beneficial, during major power conflicts, you want to ensure you're not overexposed to regions that could become battlefields or face economic sanctions. This is particularly important for exposure to Chinese markets, Russian markets, and other countries that could face economic isolation during conflicts. Pay attention to currency hedging if you have significant international investments. During wartime, currency markets can become extremely volatile, and unhedged foreign investments can face additional losses from currency movements, even if the underlying investments perform well in local currency terms. Consider the timing of major financial decisions. If you're planning major purchases, retirement withdrawals, or other significant financial moves, factor in geopolitical risks. During elevated tension periods, it may make sense to delay non-essential financial decisions until situations clarify. Monitor geopolitical developments closely and be prepared to act quickly if situations deteriorate rapidly. Subscribe to reliable news sources, follow government statements from major powers, and pay attention to market indicators like currency movements, commodity prices, and bond yields that can signal escalating tensions. The companies and sectors I've outlined today aren't necessarily bad investments during peaceful periods, but they become extremely dangerous during conflicts. The key to successful wartime investing is recognizing that the normal rules change when nations go to war and positioning your portfolio accordingly before it's too late to make adjustments at reasonable prices. Remember that wartime investing isn't about predicting exactly when conflicts will start or end. It's about positioning your portfolio to survive and potentially profit from the disruptions that inevitably accompany geopolitical conflicts. The goal is to avoid devastating losses that could permanently impair your long-term financial goals while maintaining some upside potential when tensions eventually subside. Most importantly, don't let fear paralyze you into making no changes at all. The biggest mistake investors make during geopolitical uncertainty is maintaining portfolios designed for peaceful periods when the world has become much more dangerous. Take action now to protect your wealth before it's too late.